That is what we call the advanced financial reporting and analysis. The advanced financial reporting and analysis. So today I want to talk of what we call the employees benefits and talk of the employees benefits from our previous class that we did on the first topic, which was on what we call the share based. So our previous class we did on what we call the employees benefits. I mean the share-based payments. So today's class I want to do on employees benefits and do that. That is under what we call the IAS 19. We do on that employees benefits and do on this is advanced financial reporting and analysis. We do the topic employees benefits. We do the topic employees benefits. Now, this is under the IAS 19, as I've said, the IAS 19 on what we call the employees benefits. Now, when we talk about the employees benefits, we are talking about all forms of considerations that are paid to employees for services rendered. When we talk about this, we are generally talking about the salaries. We are also talking of what we call the commissions, the bonuses, even talking about the housing benefit, the car benefit, the pensions, all of them are what we call the employees' benefits. So in our case here, we'll be able to understand some of the types of employees' benefits. And again, also, we'll be able to see how we're supposed to measure them, how we also value them as per the IAS 19. So you write and say these are all forms of considerations. And write and say these are all forms of consideration. They are all forms of consideration paid to the employees, paid to the employees for services rendered, paid to the employees for services rendered, paid to the employees for services rendered, for services rendered. You add and also say, IAS 19 requires the employee benefits to be accounted for. And appropriate disclosures to be made in the financial statements. And appropriate disclosures be made in the financial statements. And appropriate disclosures to be made in the financial statements. So that is what we mean in this case. Let's talk about the types of employees' benefits. Types of employees' benefits. Employees' benefits. Can talk of the types of employees' benefits. The types of employees' benefits. Number one is what we call the short-term employees' benefits. the short-term employees benefits. Employees benefits. Short-term employees benefits. Short-term employees benefits. Write and say. Write and say. Write and say. These are benefits pair or which are settled. These are benefits that are settled within. So benefits that are settled within 12 months. Benefits that are settled within 12 months. E.g., can talk about the salaries, can talk of the bonuses, commissions, can talk of the salaries, the bonuses, the commissions. Can also talk about the housing benefits, medical benefits, the car benefits, etc. Car benefits, etc. Those are what we call in the short-term employees benefits. They should be settled within 1 financial year. Number 2, we have what we call the long-term employees benefits. Long-term employee benefits or the long-term benefits. The long-term benefits. Say these are benefits that are settled. Say these are benefits that are settled in more than 12 months. In more than 12 months. In more than 12 months. E.g., you can have what we call the sabbatical leave. The sabbatical leave. Those are what we call the long-term benefits. Number 4 is the number 3, the termination benefits. The termination benefits. Termination benefits. The termination benefits. The termination benefits. Write and say. Write and say. These are benefits payable upon. These are benefits payable upon. The benefits payable upon work being terminated. Benefits payable upon work being terminated by either the employee, upon work being terminated by either the employee or the employer, upon work being terminated by either the employee or the employer, by either the employee or the employer, on work being terminated by either the employee or the employer. That is what we call the termination benefit. The last one, we can also talk about the post-employment benefits. Post-employment benefits. Post-employment. Post-employment benefits. Post-employment benefits. And also talk of them as a retirement benefits. Retirement benefits. On what we call the pension plans. Pension plans. Pension plans. Now, when we talk about the retirement benefits or the pension plans, we are talking about the benefits that are payable on retirement. The benefits that are payable on retirement. Now, we have 2 types of what we call the pension plans. We have what we call the defined contribution plan, and we have what we call the defined benefit plan. When we talk about the defined contribution plan, We are talking about that benefit that is payable on retirement, or the pension that is payable on retirement, which depends on the amount that has been contributed to the plan by the employee and the employer. Here we relate in the cases of what we call the NSSF, because the employer contributes the amount and the employee. And therefore, the benefit that will be payable will depend on the amount that you have contributed to the plan as the employee, and what also the employer has contributed to that given plan. That is what we call a defined contribution plan. That is what we call a defined contribution plan. We also have what we call the defined benefit plan. When we talk of the defined benefit plan, we are talking about the pension that is also payable on retirement, which in this case depends on either the final salary or average salary in the employee career. Now, what do we mean in this case? Now, in the cases of a defined contribution plan, the employee is the one who bears the risk of uncertainty. What I mean is the investment risk. Investment risk, we mean the risk of not realizing or receiving that particular benefit. The employee is the one who bears that risk. But when we talk about what we call a defined benefit plan, in this case, it is the employer who bears that investment risk. So write and say, these are pensions payable on retirement, or they're defined on the post-employment benefits. You say, these are benefits payable on retirement. Benefits payable on retirement. Benefits payable on retirement. Which depends on, the benefits payable on retirement, you can have full stop there. The benefits payable on retirement, you have full stop there. And you add and say, there are two types of pension plans. There are two types of pension plan. One is a defined contribution plan. Defined contribution plan. Defined contribution plan. On that you can say, on that you just say, this is a benefit payable on retirement. This is a benefit payable on retirement. Benefit payable on retirement, which depends on the amount contributed to the plan, which depends on the amount contributed to the plan, which depends on the amount contributed to the plan by the employee. The amount contributed to the plan by the employee and the employer. By the employee and the employer. Say the employee bears the risk of uncertainty. Employee bears the risk of uncertainty, into brackets, the investment risk. The risk of not realizing that benefits. The employee, the one bears that. Number two, what we call the defined benefit plan. Defined benefit plan. Say, defined benefit plan, and you say, this is a pension payable on retirement. This is a pension payable on retirement, which depends on either the final salary or average salary in the employee career. or the average salary in the employee career. In the employee career. In the employee career. Same. The employer bears the risk of uncertainty. The employer bears the risk of uncertainty. Employer bears the risk of uncertainty. Employer bears the risk of uncertainty. Bears the risk of uncertainty. Bears the risk of uncertainty. Say it is computed or it is calculated based on accurate assumptions. It is calculated based on accurate assumptions. Now, this is what we mean. For them to compute the benefits, they may use assumption like this. For example, they may take the 2/3 of the average salary, and then they multiply by the service years. The service years. Now, what we mean when we talk of these accurate assumptions? Now, when we talk about the accurate assumptions here, we are talking of what we call the demographic assumptions or what we call the financial assumptions. When I talk of demographic assumptions, we are talking about the assumptions about the characteristics of the future and current employees and their dependents. Generally, we may talk of cases like what we call the mortality rate. That is both in employment and after employment. Can also check on the rate of employment turnover. Can also look at the medical claims under what we call the claims under what we call the medical plans and so forth. That is how the basis in which an organization can use in order to determine these benefits. So you write and say, you write there and you say, right there and you say, right there and you say, right there and you say. Accurate assumptions comprises of number one, what we call the demographic assumptions. Demographic assumptions. Number one is what we call the demographic assumptions. Demographic assumptions, and you say, these are assumptions about the characteristics of the current and former employees, current and former employees, and their dependents, and their dependent. Say, it deals with matters such as, Roman 1, the mortality rate. One is the mortality rate in both before and after employment. In both before and after employment. Both before and after employment. Both before and after employment. The rate of employment turnover, employee turnover, rate of employee turnover, rate of employee turnover. Roman number 3, you can also talk of the claims under medical plans, under medical plans. claims under medical plan. That is on the demographic assumptions. That is what they can base on. In number 2 is on what we call the financial assumptions. Financial assumptions. Financial assumption, you say it deals with matters such as, it deals with matters such as, one, it is a future salary and a benefit level, salary and benefit level. Number 2, the discount rate. Number 3 is the expected return on the plan asset. The expected return on the plan asset. Expected return on the plan asset. Now, this is it. When we talk about these pension plans, remember, it will be an asset to one party, and it will also be a liability to another party. Or it may be an asset to an organization. Or it may, at the same time, there may be what we call a liability to that organization. So in our case, because this is an investment, what we want to know is what IAS 19 requires us to determine what we call in the remeasurement changes. Is one of the components in the statement of comprehensive income. Right, and say within the statement of comprehensive income, within the statement of the comprehensive income, then the statement of comprehensive income, it includes the following components. Number 1 is the service cost component. The service cost component. One is the service cost component. Same. This includes the past, the current and past service cost, current and past service cost, the current and past service cost, together with their gains or losses, on curtailment and settlement. Now, what do we mean when we talk about the curtailment? Curtailment, we are talking about the significant reduction of employees covered by the plan. Significant reduction by employees covered by that given plan. So just write that. Curtailment means significant reduction in the number of employees. Reduction in the number of employees covered by the plan. Number of employees covered by the plan. Significant reduction in the number of employees covered by the plan. Number 2, we'll have what we call the interest cost component. When we talk of the interest cost component, we are talking about the discount rate. Discount rate, and it may also be a return on the plan asset. The return on the plan asset. And then number 3 is what we call the remeasurement. Remeasurement component. Remeasurement component. The remeasurement component. The remeasurement components, you say, this includes the accrual gains or losses, accrual gains or losses, the accrual gains or losses on the plan asset and liabilities, on the plan assets and liabilities, on the plan assets and liabilities. Now measuring define plan asset and the liabilities. Measuring the defined plan assets and liabilities. Can talk about that. How do we then measure these defined plan assets and liabilities? Now, you written say both defined plan assets and liabilities, all the defined plan assets and liabilities, all defined plan assets and liabilities at the beginning of the year, at the beginning of the reporting period, at the beginning of the reporting period, both defined plan assets and liabilities at the beginning of the reporting period, at the beginning of the reporting period, must be reconciled, must be reconciled, must be reconciled, must be reconciled with the balances at the end of each reporting period. With the balances at the end of each reporting period. With the balances at the end of each reporting period. Now, this is how we reconcile them. Let me begin by the defined plan asset. Let me begin with the defined plan asset. So for the defined plan asset, this is how we reconcile it. So we have the fair value of a plan asset. Plan asset. This is the balance brought down. This is the balance as at the beginning. So you have it there, balance there. Then we add what we call the contribution to the plan. The contribution to the plan. And also add what we call the return on plan asset. The return on plan asset. Then once you add that, you less the benefits or the pension paid. Benefits stock, the pension paid. Benefit or the pension paid. So what we get here is now the amount, generally the total amount as at the beginning, which is what we call the carrying amount. That is what we call the carrying amount. The carrying amount. So that when you get the carrying amount here, you will compare with the fair value of this plan asset. Value of plan asset. This is the balance carried down. is as at the end of the reporting. This is now the value as at the beginning. This will be the value as at the end. When you compare the two, this is where now you get either the accrual gain, or what we call loss. Accrual gain or a loss. Now, when we talk of it as a gain, when an asset increases in value, it will be a gain. When an asset reduces in value, it will be a loss. What do I mean here? If, for example, the carrying amount was 20 and the value as at the end of the year was 30, this will be a gain because the car asset has increased in value. So it will be a gain of 10. When it is a loss is when the asset reduces in value. Like, for example, if this was 25, the carrying amount, and then this is at 20, there is a loss of 20. That is what we mean when we talk of the gain or if it's a loss. We get to the liability here. The liability. Liability. This is define liability. Liabilities. Plan liabilities. So we'll also begin with here. We'll also begin with the present value of plan obligation. This will be balanced as at the beginning, brought down. The balance brought down. We add, here we'll have the current service cost. Current service cost. Current service cost. We'll also add the past service cost, the past service cost, and also the interest cost. The interest cost. The three components that I talked about here. And then we'll also less the benefits paid. Benefits paid. Now the benefits paid here. So that you get the carrying amount. So that you get the carrying amount. So that you get the carrying amount. Now the carrying amount is what we'll be able to compare with the value as at the end. So the present value of obligation. This is a balance carried down as at the end of the year. So that if you compare these two now, we'll be able to know whether it is an accrual gain or what we call an accrual loss. So if it is a gain, positive, a loss should be a negative. A loss should be a negative. So this is what you need to know here. Now, when we talk about a liability, this is an outflow. So if a liability increases in value, that will be a loss, because it means that it will increase an outflow. But when we talk about the liabilities reducing in value, that will definitely be a gain. And that is what we mean in that case. So we can have an example from the past paper. We begin with the sitting of September. That is from the advanced financial reporting paper. Advanced financial reporting paper. Advanced financial reporting. So let me reshare the past papers in the group. Let me reshare the past paper on the purposes of probably those are not having the paper. I can reshare in the group the financial reporting and the advanced financial reporting and analysis paper. The purposes of those that are now having the paper, you can now confirm. I've basically just shared with you. We have reshared the paper. So that is it. Confirm on whether or not that you have in the paper. And if you have in the paper, and if that's so you have in the paper, we can go to the sitting of, that's all you have in the paper. We go to the sitting of September 2015. Go to the sitting of September 2015. September 2015. September 2015. September 2015 should be question number 4A. September 2015. It's just the last page in the paper that I've shared. So you look at September 2015, question number 4A. September 2015, question 4A. September 2015, question number 4A. September 2015, question 4A. So this is what you've been given on that particular question. That Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the value of the pension plan asset was 2.6 million. And the present value of the plan obligations were 2.9 million. They actually estimated the current and past service cost the year ended 31st December 2014 at shillings 450 and 90,000 respectively. The past service cost It's caused by an improvement in the pension benefit commencing 31st December 2014. Pension plan paid 240,000 to the plan. And on the same date, Volta Limited paid 730,000 to the contribution to that plan. Interest on high quality corporate bonds. The year ended was 8%. As at the year end, fair value of pension plan asset was 3.4 million. Present value plan liabilities were 3.5. In accordance with the IAS, with the year 2011 revision to IAS 19, Volta Limited recognized remeasurement gains and losses in the other comprehensive income in the year they occur. So you are required to read the measurement gains or losses on the pension plan assets and liabilities that will be included in other comprehensive income the year ended 31st December 2014. So remeasurement gains or losses, these are the actuarial gains or losses. And for the purposes of published financial statements, these remeasurement gains and losses, we include them on what we call the other comprehensive income. And this is in the statement of comprehensive income. So let's compute what should be taken to the other comprehensive income. So I'll begin with the defined benefit plan. Begin with the defined benefit plan. So shillings here, let me use shillings in thousands. So I will have the shillings in thousands. So we begin with the fair value of plan asset. Value of plan asset. They should be balanced, brought down. The fair value of plan asset, balanced, brought down. So we've been given here, it was 2.6. That is from the first paragraph, 2.6 million. Then we also add the contributions to the plan. Contributions to the plan. The contribution to the plan, we have them here. We've been given there, they were on the that paragraph. He contributed 730. Then we also had the return on plan assets. Return on plan asset. When we talk of the return on plan asset, it will depend on the interest rate. So it depends on what, in this case, you are having as at the start of the year. So I'll just get the interest rate of the coverage bond multiplied by the value as at the beginning. So how much is it giving you? Inakupea ngapi? How much is it giving you? So it will be 2,600 multiplied by 8%. So this is 208. And then we less the benefit paid. So what was the benefit paid? Benefit paid we were also given. It was from also the second, that paragraph was 240. So you less 240. So how much is it given you as our carrying amount? How much is it giving us as the carrying amount? Carrying amount is, you getting how much? Carrying amount 3298. 3298. You compare with the fair value of plan asset. This is balance carried down. Now, it was given as 3400. So what is it again, or is it an accurate rose? When you look at the asset here is increasing in value. So it is giving us a gain. So it is an accurate gain of how much? Accurate gain of how much? Getting an accurate gain of how much? To be 3400, 3298. It is a gain of 102. The accurate gain of 192. We also go to the defined plan liabilities. The defined plan liabilities. Also have the defined plan liabilities. Defined plan liabilities. Now for the defined plan liabilities, here, we'll have the present value. This is our plan obligation or plan obligation. Obligations are now liability. Balance as at the beginning. Let me have the balance carried down. Balance brought down. We also have shillings them in thousands. From the first paragraph, we were given 2900. So you will add the current service cost. So service current cost, in this case, we were given as 450. And we also have the past service cost. In the first service cost here, we have how much? First service cost, we have 90. We'll also add the interest here, the interest cost, which is now the interest on the obligation. Will based on the corporate bond interest, and this will be for the amount as at the beginning, or the value as at the start. So 2900 multiplied by 8%. This is 232. And then I will less the benefits paid. Benefits paid was 240. So you less the 240. So this gives us the carrying amount. Which was of how much? Which is of how much? 2900, 450, 90, 232. Then you minus 240, getting 3432. Then we compare with the present value of plan liabilities. Present value of plan obligation. This is a balance carried down, which we were given as 3500. So it will give us how much? Now this is a liability. And when a liability increases in value, that will be a loss to the entity. So this will be an accrual loss. It is a loss of how much? It is a loss of 68. So this is a negative. So to other comprehensive incomes, what do we take here? Other comprehensive incomes. To other comprehensive income, what will we be able to take here? It will be now their curio changes. Curio changes. So it will be the gain which is of 1 or 2. Remember, I had used shillings and thousands. So it will be 1 or 2,000. You minus 68,000. So it will give you how much? 34,000. So this is what we'll take as a gain on other comprehensive incomes. And that is what you are required to do on that particular question. You are to do it that way. That is how you are required to do on that case. We continue. We continue. Now we can do another question. The sitting of December 2017. And also do that. December 2017. December 2017. December 2017. December 2017. Question number 2, December 2017. Should be question number 2C. Also do that. December 2017. Question 2C. And also do that one. December 2017. Question 2C. December 2017. Question number 2C. So this is what now the question reads. That the following information was extracted from the books of Combot Limited. And this is for the year. Combot Retirement Benefits Scheme for the years ended 31st October 2016 and 31st October 2017. Also been given the discount rate on 1st November. Given also the expected rate of return on plan assets on 1st November. And then we've been given the average remaining service life in years. The value of plan asset on 1st November, present value of the obligations on 1st November, current service cost, and the benefits paid, contribution to the scheme, and we have the past service cost. Additional information as at 1st November 2015, present value of plan obligations and the fair value of plan assets were both 100 million. Few more transactions occurred at the year end. For each of the years ended 31st October 2016 and 2017, you are required the accrual gains or losses, the net pension cost to be charged in the income statement for each of the year, and then also the balances or to be reflected on the statement of financial position. So we can have it here. So we begin with the define plan asset. Can begin with the defined plan asset. Here we have for 2 years. We have for 2016. And I will also have to do for 2017. Both of them, the shillings are in thousands. So our shillings are in million. So I'll have shillings in million and also shillings in million. So we begin with the first one, the fair value of land assets. This should be balanced brought down. So it was for 2016. Remember, the year ends on 31st October 2016, meaning we need to know the value on 1st of October, I mean 1st of November 2015, which we've been given on additional information number 1, it was 100. So meaning that the value at the end of 2016 will be the beginning of 2017, which we've been given there on the balances. Fair value of plan assets on 1st November 2016, it was 96. Then we continue here. I will add contribution to the plan, which is the scheme now. Contribution to the plan we've been given there, or the contribution to the scheme, this one was 9, this was 11. And then also we have the return on plan assets. I will add the return on plan assets. So the return here will be the percentage. We were given the expected return there. This one will be 12% of the value as at the beginning, 100. This will be 12. This will be given as 10% of the value at the start, 96. That is 9.6. And then we less the benefits paid. Benefit paid here was 15. This other one, it was 12. So we can get the carrying amount. And get the carrying amount. So what is our carrying amount here? Will be 100. 9, 12, then you minus 15. This is a 106. The other one here, the carrying amount is 96 plus So we continue. We continue. How much are you getting for this other one? The entry is telling me 104.6. So we'll have 104.6. Now, this is what we compare with the value as at the end. The bare value of plan asset, balance carried out. So the balance as at the end. For this one will be, end is the 96 year. Remember, end of this is the beginning of this other year. And then also for the other year, we've been given there that, it was how much? We've also been given there on the question that it was of how much? It was 110. So you check. Now, we want to know whether there was a curio gain or what we call an curio what? Curio loss. Here you can see we have both the curio gain and we have a loss. That is why I put this as a loss into brackets. So when you look at this is the value at the beginning, which is what we are reconciling with the value as at the end. So 106, the value of this asset is reducing, and meaning that, as I said, when an asset reduces in value, it is a loss. So this is a loss of 10. Then for this one, it is a gain because it is increasing in value, and it is a gain of how much? 10 you minus 104.6. This is a gain of 5.4. A gain of 5.4. That is on what we call the defined plan asset. We do the same for the defined plan liability. Plan liability, or what we call the obligations. So I will also begin with the present value of plan obligation. This is balance as at the beginning. Balance brought down, which we were given on the same on additional information number 1. It is 100. As at the end of year 2016 will be the beginning for 2017, which we were given as at the end for 2016, still 100. So I'll add current service cost. Current service cost. Current service cost here is of how much? It is of 8. This is 10. We also add the past service cost. Past service cost. Past service cost here will be of how much? This past service cost we've been given only for year 2016. And then the last one will add the interest cost. Interest cost is the discount rate, and the discount rate on 2016 was 10%. So it will be the 10% of the amount as at the beginning. This will be 10. This is 8% of the amount as at the start, 100, which will be 8. Which in this case is 8. And therefore now we less the benefits paid. Benefits paid. So benefit paid here was of how much? Here it was 15. Here it was 12. So we can get the carrying amount. Carrying amount. So the carrying amount is of how much? So for the first one, it will be how much? 100 plus 8 plus 4 plus 10 minus 15. This is a 107. Another one is 100 plus 10 plus 8 minus 12. This is a 106. And then from there you can have what we call the present value of obligation balance carried down. So as at the end of the year, this was 100. As at the end of the year, this was of how much? We've been given there is 125. 125. So what we have here, this is a liability. So we'll have what we call an accrual. Here there is an accrual gain and there is also a loss. Now, when a liability reduces in value, like in our case here, this one is reducing in value. It is reducing in value by 7. This is a gain because this is a liability. 7. When a liability here increases in value, it will be a loss. So it will be a loss of how much? It will be a loss of 19. And that is the accrual gain or loss. So for the accrual changes for both of the year, for 2016, the accrual changes. This is for the 2 years. For 2016, it will be the gain year, which was of how much? I mean, the loss year of -10. You add this gain of 7. So it will just be -3. Remember, they are in millions. For 2017, it was a gain of 5.4. You minus a loss of 19. So it is still given as a what? A loss of -13.6 million. A loss of -13.6 million. That is from the Roman number 1. From the Roman number 1. The accrual gains or losses. So generally the accrual changes. The accrual changes. Now we go to the Roman number 2. Now the net pension cost. And this is for the 2 years. In Roman number 2, the net pension cost. Now, for the net pension cost here, we want for the 2 years, 2016, and also 2017. Shillings are here in millions. We have them in millions, yeah? Millions. Shillings in millions. Shillings are there in millions. So you can have, here we begin with the return on plan asset. This is a gain. So the return on plan asset here was of how much? This one was a 12. This other one was 9.6. Then you less all the cost from the plan liabilities here. So the cost here is the current service cost, which in this case was of how much? This is 8 and 10. 8, 10. We also have the past service cost, which here it was 4 and 0. And then we'll also have the interest cost. Interest cost. The interest cost here, it was 10. And this other one is 8. So what we get here is the net income, net pension cost, which is a negative. The reason it's a negative is because it will be a cost. So the net pension cost will be of how much? Get the difference, 12. 8 minus 4 minus 10. 12, 8 minus 4 minus 10. This is equals to how much? Negative 10. We'll have it as a positive value, a cost. Then the other one, 9.6 minus 10 minus 8. This will be 8.4. 8.4. That is also how we present that one. We continue. Problem number 3. And I've said since it's a cost, you man hapa inatupia ikiwa negative, but we take it as a positive value because it's a net pension cost. Roman number 3, balances to be reflected. This is in the statement of financial position. So the balance is to be reflected in the statement of financial position. I will have for 2016, 2017. Here I will have shillings in million. The shillings in million. Shillings in million. So we'll have the assets. On the non-current assets, we'll have the plan assets, non-current assets. These are long-term investments, remember. Pensions are long-term investments. And therefore, that is why I will have the plan asset here. Then plan asset, which in this case will only need, we put the values as at the end of the year. This was 96. The other one was 110. At the end of the financial year. You'll also have on the part for equity and liabilities. On equity and liabilities, on the equity part, we'll have what we call the accrual reserves. Accrual reserves, generally they are the accrual changes. This was -3, -3 here. The other one is -13.6, the accrual changes. And then we'll also have the non-current liabilities. Non-current liabilities. On non-current liabilities, we have now the plan obligations or liabilities. Plan obligation or liabilities still as at the year end. And the plan liabilities or in this case will be of how much? This was 100. The other one was 125. And that is how you want to do on that part. So that is all you want to do on that particular question. That is how you want to do on that particular question. Any question up to that point? Any one with a question up to that particular point? Any question? Any question? December 2023, we can also do that. December 2023, question 1C, the last one now. December 2023, question 1C. December 2023, question number 1C. December 2023, question number 1C. December 2023, question 1C. December 2023, question number 1C. Saruji Limited operates a defined benefit scheme which had a net obligations of 120 million as at 31st December 2021. Following details relate to the scheme for the financial year ended 31st December 2022. So you've been given the current service cost, the cash contribution to the scheme, benefit paid during the year, net loss, and we have the gain on remeasurement liability as at 31st December 2022. The rate of interest applicable, this is to corporate bonds, was 5% as at 31st December 2021. Cash contribution to the scheme have been correctly accounted for in the financial statement for the year ended 31st December 2022. This is the only adjustment that has been made in respect to the scheme. So you recommend to the directors of Saruji Limited the correct accounting treatment of the above transaction in the financial statement ended 31st December 2022, including financial extracts in accordance with IAS 19. So we can do that very fast. This is only on the basis of defined plan liabilities. So we can do for this one, shillings in millions. So here is the defined plan liability. Defined plan liabilities. So on the defined plan liability, I will have the present value of obligation. This is the balance as at the beginning. Balance brought down. So balance brought down, we were given on the first statement. It was 120. Number two, we'll add the service cost. I've been given the current service cost. So I will add the current service cost, which in this case was 55. We'll also add, we don't have the past service cost, what we have here, there was the net loss on curtailment. Remember, when I was talking about within the statement of comprehensive income on the service cost component, we said it included the service cost comprises of the past and current service costs with gains or losses on what we call the curtailment or settlement. And since this is a loss, I will add net loss on curtailment. We'll add it here. It was of how much? 11. Then I will less the benefits paid. Benefits paid here was of how much? Benefits paid here we've been given as 80. So what is our carrying amount? Carrying amount. So the carrying amount here will be of how much? 120 plus 55 plus 11 minus 80. This is 106. Now, we don't have the present value of obligation as at the year end. This is what we want to know. Balance carried down. Hii ndo tunataka kujua. That is what we want to know. Since we already know it was a gain. So it was a gain of how much? We were given the gain on remeasurement. This is as a 31st December 2022. So this was an accrual gain. There was an accrual gain of how much? We've been given that. The accrual gain was of 9. And we know this is a liability. For it to be a liability, when a liability reduces in value, that is when it is a gain. When it increases in value, that is when it is a loss. And therefore, we want to know it had reduced by what value for it to be that. So I'll take 106 minus 9, which in this case will give you 97. So 97 is the present value of obligation as of the year end. So now, we are also required to show how we present that on the financial statement. So this accrual gain, the accrual gain, we know should be included on other comprehensive incomes. Comprehensive income. And this is in the statement of comprehensive income. In the statement of comprehensive income. In the statement of comprehensive income. That is it. Then we are also to illustrate how we're supposed to present all these. So here I'll just include the balances. Balances in the statement of financial position. Statement of financial position. Financial position. So this is it. We are talking about liability here. So I will only consider the part of equity and liability in millions, yeah? So what I will include is only the accrual what? The accrual reserve, yeah? Which will be a gain of 9 million. And then I will go to the non-current liability. Non-current liabilities. Liability. Here I will include the plan obligation, which is as at the year end obligation. And by the way, there is something that I forgot here. Let's just correct here. After benefits paid, I forgot the interest cost. So include this interest cost, which should be the 5% of how much? I've seen there was that interest of the value as at the beginning, 120. Here tumesahau 0.05, 120. We forgot this 6. This was 11. I forgot the 6. Hiyo itabadilika. So 120, 55 plus 11 plus 6 minus 80. This should be 112. So that 112 you minus 9. This should be 103. So what we take on the liability should be the 103. That should be the 103. So that marks the end of the topic, the employees' benefits. So at your own time, you will do the following as assignments. At your own time, you can just do the following as assignments. At your own time, you just do the following as assignment. You will do the following as assignment. You will do the following as assignment. So for the assignment, will be from the old past paper. It will be from the old past papers. So you do the following as assignments. I have also reshared the papers again in the group. So you will do the following as assignment. You will do the following as assignment. Do December. You will do not December, but should be May 2014. So do May 2014 question number 4B. May 2014 question 4B. May 2014 question 4B. You will also do in the sitting of December 2012 question 4B. Sitting of December 2012 question 4B. Question 4B. Yeah, just do those two as assignment. We continue from there in our next class. We do on the operating segments. The operating segments. So, don't know whether there is anyone who is having a question. Any question? So let's just continue from there in our next class.